Welcome to RBC's Markets in Motion podcast, recorded December 9th, 2024. I'm Lori Calvasina, head of US Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. 3 big things you need to know. First, positioning in US equity futures per the weekly CFTC data has taken a tiny hit. Second, consensus US GDP forecasts have moved up, along with consensus Fed fund and 10-year yield forecasts. And third, other things that jump out in our high-frequency indicators include the continued decline in bottom-up consensus 2025 S&P 500 operating margin forecasts, geographical equity fund flows dynamics, and recent sharp inflows into momentum equity funds. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number 1. Positioning in U.S. equity futures has taken a tiny hit. Last week, we spent several days meeting with investors in U.S. equities that are based in Canada, giving us useful perspective into how international investors, who also know the U.S. market well, see the state of U.S. equities today. We asked them their own views and found that most had difficulty assigning a bullish or bearish label to themselves. Most believe the U.S. equity rally will continue a bit longer, but have a significant pullback in their sights, though the duration of the current rally and the timing and depth of the potential decline were not uniform. This context made last week's CFTC futures positioning data all the more interesting to us. Friday's update revealed that buy-side U.S. equity futures positioning has moved slightly lower after hitting a new all-time high. This was also the case for the major equity contracts we're tracking: S&P 500, NASDAQ 100, and Russell 2000. Prior to Friday's update, these charts were already of great interest to the investors we spoke with. The thing that's been jumping out to us and resonating with investors is that S&P 500 futures positioning has recently been making new all-time highs and is well above past peaks, which also happened in late 2017 and early 2018, with a peak in January. That January 2018 peak occurred after a sharp move up in the S&P 500 in 2017, more than 19% on an annual basis, due in large part to excitement over the tax cut bill that passed in December of 2017. The similarity in the data begs the question of whether U.S. equities have already pre-traded some of the political tailwinds expected by many investors to be seen in 2025. Moving on to takeaway number 2. Consensus U.S. GDP forecasts have moved up, but so have consensus interest rate expectations. What we're seeing on the CFTC data is a concerning data point for the U.S. equity market and helps to make the case for a pullback before too long. It can also be viewed as a data point supporting the bear case in the S&P 500 that we outlined in our recent Outlook report. But it's important to note that there was also a constructive data point for the U.S. market that came out last week. Specifically, the consensus real GDP forecast for 2025 continued to move up and now stand at 2.1%. The move higher in consensus GDP forecasts has been driven by upgrades to consensus 1Q25 real GDP views, which speaks to the idea that political tailwinds from the unlocking of business activity are expected to show up in data to start the year. That bit of good news for stocks was somewhat offset by the increase in consensus forecasts for Fed funds and 10-year yields that has also been seen. Note that in our price target modeling, the increase in consensus GDP forecasts is a supportive data point for stock market returns. Our work indicates that stock market returns tend to be weak in the 1.1 to 2% range, but strong in the 2.1 to 3% range. However, higher Fed funds and 10-year yield forecasts are negative data points for the stock market, as our work indicates that higher numbers on these two metrics tend to pressure trailing PE multiples for the S&P 500. We'll wrap up with takeaway number 3. Some of the other things that jump out on our high-frequency indicators as 2024 winds down. The first of these that we'll highlight is on earnings. Although the bottom-up consensus for 2025 S&P 500 EPS has been holding steady at $2.75, implying a growth rate of just under 13%, it is worth noting that consensus forecasts for 2025 operating margins have continued to fall. Disappointing guidance in year-ahead outlooks has been coming up in our recent conversations with investors as one possible catalyst for a broader market pullback early in the new year. And it's interesting to us that stock prices seem to be ignoring the more pessimistic outlook for margins so far. Next up is another sentiment gauge. Concerns about tail risk as measured by the TDEX indicator continue to track below recent highs but are also still elevated versus history. We think this is a fair representation about how the balance of risks has shifted for stocks in 2025. Next up is the results of the Duke CFO survey, which came out last week. Confidence in their own companies and the broader economy both did rise. Confidence in the former continues to outpace confidence in the latter, although the gap is closing. Post-election, Regulatory policy is seen as the most important topic among CFOs. Shifting a bit to funds flows. Inflows to U.S. equity funds have remained robust per EPFR's latest update. Meanwhile, inflows from European equity funds, including Western Europe, the UK, France, and Germany, have continued to deepen. Inflows to Canada remain strong. And last but not least, we've recently started tracking flows to developed market equity factor funds and have been struck by the sudden strength in flows to momentum equity funds to end the year. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.